All right, let's talk about one of the biggest journeys you're ever going to take, your financial life. Today, we're going to map it all out. And to do that, we're going to follow a character. Let's call them Alex, as they step out into the world of money for the very first time. Let's get into it. Okay, so picture this. Alex lands their first real job. They get that first payday email, $2,000. Awesome. But then they check their bank account, and there's only $1,456 in there. What on earth happened? This right here is the first financial shock pretty much everyone gets, and it's all because of taxes. So yeah, this is chapter 1 of Alex's big adventure. That paycheck, it's like a puzzle. You've got pieces being pulled out for things like federal income tax, Social Security, and Medicare. These are basically automatic deductions that take a slice of your earnings before you ever get a chance to touch them. So let's break down what these things actually are.
When you boil it all down, taxes are really just the price we all pay to live in an organized society. That money that vanished from Alex's paycheck, it goes toward building roads, funding schools, and just, keeping all the public services we rely on up and running. Think of it as your membership fee for civilization.
So your tax money flows into a few different buckets. You've got your federal and state taxes, those are the big ones. Then you have Social Security, which you can kind of think of it as a retirement savings plan that the government makes you contribute to. And Medicare, which is basically health insurance for older folks and people with disabilities. It can feel like a lot coming out of your check for sure, but every single deduction has a specific job to do.
All right, so Alex has their $1,456. Now what? I mean, they could just stuff it in a shoebox under their bed, but there's a much, much smarter place for it. And that brings us to our next stop on the roadmap, the bank.
Most of us think of a bank as this giant, super safe vault, right? But what they do is actually way more dynamic. A bank is more like a financial matchmaker. When Alex deposits their paycheck, the bank doesn't just lock it away. Nope, it takes that money and lends it to someone else who's trying to buy a car or maybe even start a business.
And this brings us to a super powerful concept called interest. It's how banks make their money. And a really simple way to think about it is as the rent on money. It can be either a cost to you or a reward for you. It just depends on whether you're borrowing or you're saving.
So interest really has two different faces. When Alex borrows money, say for that car, interest is the extra price they have to pay. But when Alex saves or invests money, interest becomes their best friend. It becomes this powerful tool that earns them more money 24/7, even while they're sleeping. It's like having an unpaid employee who just works for you all the time. And this is where the real magic kicks in. Let's just say Alex invests their money and it earns an average of, say, 7% a year. Because of something called compound interest, that money doesn't just grow, it snowballs. Seriously, a $1,000 investment earning 7% would be worth almost $4,000 in 20 years without ever adding another dime. It's the slow and steady secret to building real wealth. Okay, so now we've hit a classic problem. Alex absolutely needs a car to get to their new job, but they just don't have enough cash saved up. This means they need to borrow money. But how does a bank or a lender decide if Alex is trustworthy enough to get a loan? Well, that brings us to our next big topic. Welcome to the credit game. Now, this game isn't really about how much money you have in the bank. It's all about how reliable you are with money you've borrowed. And this whole system is built around one single number that acts as your financial trust score. And that number is, of course, your credit score. It's a 3-digit number, usually somewhere between 300 and 850, and all it does is answer one simple question for lenders. If I give this person money, what are the odds they'll actually pay it back? A high score? That's like a VIP pass. It opens doors to better loans with better rates. A low score, though, can really limit your options. So how in the world is the score even calculated? Well, it's mostly based on 5 things. First, and this is the big one, is your payment history. Just paying your bills on time every single time. That's the largest chunk of your score. Next is credit utilization. This is just a fancy way of asking how much of your available credit you're using. Lenders want to see you using just a little bit, not maxing everything out. Then you have how long you've had credit, the different types of credit you have, and finally, how often you're applying for new credit. Each little piece helps build a picture of your financial habits. Now, here's the thing. Alex's financial life doesn't exist in a vacuum. It's connected to these massive economic forces that are way bigger than any one person.
Sometimes you can feel like you're doing everything right with your money, but things still feel tough. And you should know, it's not just you. It's the economy.
So, the first big economic force we have to talk about is inflation. And here's the best way to think about it. You ever buy a bag of chips and you open it up and it's like half empty? The price was the same, but you got less for your money. That's inflation. Alex's dollar is still a dollar, but it just doesn't buy as much as it did last year. It's so frustrating.
So what causes this? Well, it's usually a mix of things. Sometimes there's just too much money chasing too few goods, so prices naturally go up. Other times, supply chain problems make it more expensive to make and ship things. And weirdly, sometimes if we all just expect prices to go up, the way we spend our money can actually make that happen. For Alex, this means that car they're saving for might get more expensive next year, and their budget for gas and groceries just keeps getting tighter.
The other major economic force is a recession. Now, that word sounds pretty scary, but it can be helpful to think of it more like the economy's reset button. During a recession, things just slow down. Spending decreases, and unfortunately, some jobs might be lost. For someone like Alex, who's just starting out, this could mean it's harder to find a job or get a raise, which makes being careful with your budget even more important.
But the most important thing to remember here is that recessions are part of a natural cycle. See, the economy goes through these booms where everyone's spending and things are great. Then it hits a peak. After that, it might enter a bust, which is the recession. But, and this is key, after the bust comes the reset, where the economy rebuilds and starts to grow all over again. We have seen this pattern happen again and again throughout history, so planning for these cycles is just a smart part of any long-term financial plan.
So, after all that, what's the biggest takeaway for Alex, and really for all of us? It's that building a solid financial life is a marathon, not a sprint. It's all about making small, smart choices over and over again for a long, long time. And your most valuable asset isn't money, it's time. Your journey is really just getting started. So, what's the first small step you're going to take?